get rolling.
Yeah, for those that know Hyper, I'm Jessie from Hyper. I work in the London team here, and we have been partnered with Cake in Australia for a little while now. And when we heard they were moving over to the UK, we knew that we had to set up partnership with them here. So that's this is sort of the first event to kick that off. So Jason's going to run through the startup sort of capital raising cycle, and then we'll have Q&A at the end. If any questions pop up, in the meantime, please pop them in the Q&A section so we can just keep track of them instead of the chat section. And yeah, I'm going to hand over to Jay. So
yeah, thanks, Jessie.
Yeah, great to be here. One of the co-founders of Cake. Myself, I've run 5 or 6 rounds from pre-seed to pre-series A. I coach and advise heaps of founders. I've worked with founders and investors in the UK and Singapore and Australia. So yeah, heaps of experience. We've got over 1,000 startups on Cake now, and we're growing really fast. And we're really excited to be in the UK more recently. As it sort of says here, we're also in Singapore and India and the US as well as Australia. So, providing all these equity related services for startups all over the world. And it's our mission to make sure that equity is as easy to use for you guys as possible. Today, we're going to focus specifically on capital raising, which is one of the most important, but also complex and difficult things to do for a founder. To give you some context, I have a finance background. I'm a former CFO, and when I first came into startups to run a capital raise, I just could not believe how hard it was, how many steps there were, and there really wasn't any rule book or shortcuts or and of course there's stuff on the internet, but it's here, there, and everywhere, and to piece it all together as a founder is like just such a difficult thing to do. So we built the software to help with some of it, and we have these sessions, and we built a capital raising toolkit just to try and help get as many of the hacks and tricks and things that you can do to make your life easier. So I'm going to try and go through as much of that as I can today. We also have some takeaways for you, including this recording and the toolkit itself, which has heaps of resources in that, which I'll get into in a minute. Yeah, love partnering with Hyper. They do really cool things in the startup space, really parallel to us. While you're building your product and getting your product market fit, you need to be working on building your investor list and getting your data room ready and doing your preparation checklist. So you kind of want to have the both things going at the same time. So it's a really good partnership, because we cover 2 really important aspects of your journey. Yeah, so today we're going to talk about tricks and hacks. I don't mean that in any sort of flippant way, like it's serious stuff, I know, but there really are fast ways and slow ways to do a capital raise. And I think, you can easily double the amount of time that your raise will take if you do things the slow way and you don't sort of learn from others. So specifically today, I know this is going to be probably an earlier stage, group. What's interesting here, if you think about it from a financial perspective and you look at this diagram here, and you can see early stage there right in the middle. From a financial perspective, early stage actually talks about Series A and Series B. And Series A is often talked about as the first round. But for us founders, there can be quite often 1, 2, 3, 4 rounds before you get there, and a lot of pain and a lot of hard work. And then you finally get product market fit and you're scaling, and then, the VCs are jumping all over themselves to stuff money into your company, to get on the rocket. So, so we're going to focus on the very first round. So pre-seed, was called friends and family. It's not really called that anymore. Pre-seed, seed, Series A to a degree. Obviously in there can be seed 2, there can be pre-series A. So all that stuff is largely very, very similar. We're going to cover a lot of that. And look, the environment we're in is very, very hot. I'm sure you all know, or if you don't know, like this is a good session for you. More investment into tech every quarter after quarter after quarter for the last couple of years, record after record after record. It's a great time to be raising. You can raise faster, you can raise more. The valuations are better almost than ever before. There has been a little bit of a softening for those of you that are a bit more financial or being, keeping up to date with the trends. Just this last quarter, listed company multiples and valuations have come down quite a bit. That is sort of flowing through into, in the venture space, but it's not really causing any concern or any slowdown in the amount of capital or valuations or anything like that, as far as I've seen at this stage. But it's probably worthwhile just being aware that when there's a downturn in capital markets and a rise in interest rates, not this is financial advice, it's normally a good time to get the capital that you need reasonably just get into it get it done in a reasonable time frame, just in case it does continue to sort of roll over, and then you get into those difficult times where it's hard to raise, what we always want to avoid. So a lot of what I'm going to talk about tonight is just learning from others. There is a lot out there that a lot of lessons that have already been learned. And so what I'm going to talk a bit about tonight is, how to simplify a lot of things, how to save a lot of time when you're raising, and a lot of pain and a lot of work, right? And we all need that as founders because there's heaps to do. So we're going to talk about how to simplify your valuation. We're going to talk about how to simplify your legal documents. We're going to go through a step-by-step guide of how to actually run your round. Little things like, I see a lot of very early stage founders building an incredibly complex, 5-year financial model. Some will even go out of their way to spend, thousands on paying consultants to do that. But you don't need that. Investors don't want to see that. Good investors don't want to see that, because they understand that the very early stages of a startup is about learning all that stuff. What should my pricing be? What's my customer acquisition cost going to be? What are all the unit economics? And, there's so much to learn. It's much more about learning. And you do need a model, don't get me wrong, but you just don't want to make it too complicated and just get bogged down in the detail. So following a tried and tested process is important. What we did at Cake is we put all of our lessons and all the stuff, that we've done and all the mistakes we've made, we put all that into this capital raising toolkit. You're going to get a link to this at the end and in an email. As I say, it's got evaluation, simple valuation, it's got simple cap table modeling, it's got data room checklist, it's got tons of stuff in it, all in the one place, all best practice. We're constantly testing it with different stakeholders and leaders in the industry to improve it. There's 3 major phases in a capital raise, and you do need to treat each phase as a separate phase. One of the biggest mistakes founders make is that they run it as just one big blob. They'll be going out doing marketing, talking to investors, trying to raise money when they haven't prepared properly. They'll be thinking they're closing when they're still doing marketing. And if you make these mistakes, trust me, it'll blow out the whole time frame and even potentially kill your round. So to explain a little bit more about that, this is the first phase checklist from the capital raising toolkit that you'll get later. So these don't all have to happen in this order or anything, but they all have to happen before you go to the marketing phase. So this marketing phase here, you should not start this phase until you've finished this phase. The reason is, well, let's go through some of the reasons. Well, let's go through this and I'll cover that in a sec. All right, so short pitch deck, we all know we need a pitch deck. Long pitch deck. So why do you need a short pitch deck and a long pitch deck? The short one is for sending out when you're doing your marketing. So not your marketing, when you start your marketing, it's the first thing you do. So you send that out to all the investors that you think might want to talk to you. That's designed to get you the meeting. In the meeting, you pitch the long pitch deck, and then you give the long pitch deck to the investors afterwards so they can start their DD. It has a lot more information in it, and it goes to the analysts. They pick through it, they check, generally if they want to proceed. And normally after that is when they'll come back and look to go further with your round if they want to or not. So really important that you have 2 pitch decks. The data room, again, of course, you've got to have some stuff in a data room. Quite often I'll see founders going out, having meetings without a data room. What happens then is you do have a really good meeting, and with a sophisticated investor that invests in tech a lot, if you have a good meeting and they ask you for the data room and you can't give it to them, they will almost always not invest. So you have to stack the deck in your favor. The deck is actually stacked against you so hard. I'm sure you've all heard, you know, investors only invest in 1 in every 100 deals they see. Now, if you're a 1 in 100 chance, and I'm not saying you are, because if you're a really good founder with a really good offering, you'll be able to get investment. But if you're generally in a 1 in 100 situation, you don't want to be shooting yourself in the foot by not having these things done. So in the toolkit, and this toolkit's free, by the way, it's a free resource that we made just to help founders. There's a data room checklist in there, and you just tick that off. If you're doing your pre-seed round, your very, very first round, there's not that much stuff that needs to be in there because you haven't done anything, right? It's just going to be your incorporation docs and, you know, the summary of your cap table, maybe a couple of legal agreements for your couple of employees or whatever you've got, right? It's going to be pretty simple. There might be some IP stuff in there around, you know, do you own your own trademark? Which company actually owns the domain that you're hosting? And is it the same company that they're investing in? So there's a few basic things you still need to do. As you go through seed and seed plus and you get to Series A, obviously the obligation of the data room increases significantly because there's so much more money coming in, there's so much more risk for the investors, the sophistication of the investors and the amount of time they spend on DD increases. So depending on what round you're doing, you need to understand the amount of data room information to provide. A simple valuation. So we've got a template in here for that. If we get time today, I'll actually go through it. There's some very simple methods for how to do a very early stage valuation. If people want me to go through that, please do put that in the chat. I can save 5 minutes for that at the end. A simple financial model. So again, there's a link in the toolkit that talks about the type of model you should be doing. It's not a massively detailed 70-row, 5-year model. Like, you don't know enough, and every quarter everything changes in a startup unless you're like, actually, I don't even think it's possible to not be that case. Like, I've done this before. I'm a former CFO. I've done this before. I make the big model, and then like the minute, well, actually by the time you've raised the money, because you make the model, you run the round, you get the money, and then you look back at the model and you're like, oh no, I can't hit any of those numbers because like every single number has changed. So there's too many assumptions. And too many variables and too many things change. So there is a way to do modeling well. It's about trying to understand what unit economics you do know now, what testing you've done, what unit economics you're trying to test in the next quarter, and what you're trying to validate. And then, still doing a 12, 18-month forecast, because you still need to know roughly what you think you're going to spend your money on. But there's definitely a right way and a wrong way to do that. And there's definitely a short way and a long way to do that. Preparing a cap table as well. So you need to be able to explain to the investors who owns what shares are on issue now. Are there any convertible notes? Is there, employee options? How is the whole cap table structured? You need to be able to show that to the investors before and after the proposed round. So what happens when the new money comes in? Is there any increase to the option pool? All those things need to be able to be modeled by you and shown to the investors. And we've got a template in there for that as well. So this is a global thing. So we've got safes here in the UK. I know you guys don't really run with safes, but need to make a decision whether you want to do an equity round or a note. Don't necessarily have to make that final decision, because sometimes that comes out during the round based on what the investors want as well. But it's nice to at least know what you're going to do there with regard to your legal documents. Simplify those as much as possible as well. There's templates out there. Inside the Cake software, we have all the legal agreements that you need, and there's really great ones out there in open source as well, if you choose to go that way. Otherwise, if you are going to use a lawyer, make sure you use a startup lawyer. There's lots of lawyers out there that might be good in whatever industry or for mid-cap companies and stuff like that, but they're going to do a disservice on your startup stuff. So really work with startup people. You're going to get a much better outcome. The next one, the next two are really important and quite often overlooked. So I'm going to go through this investor list thing in a minute, specifically about how I see the best way to build an investor list. And building investor relationships is critical as well. I'm a little bit like, I'll just share from my own experience. Like, I'm just going to reset my timer so I don't gas bag too long and I leave time for questions. Yeah, like it's really easy to sort of make the mistake early on to think that when you meet an investor, they're going to invest. It's much more likely they're going to want to follow you for several months, have seen you deliver. So it's really important that you meet someone, and, you have a coffee, you meet them, or you're at an event, you meet them, you say, I'll just pop you on my update list. And then you start sending them monthly updates. What that means is if in 3 months' time you want to go and raise capital from them, they see that you're diligent and you're disciplined and you're hardworking, and they can go back through your updates and they can see that you made progress, and it will increase the chance of them investing in you like fivefold. I 100% guarantee that. So yeah, you got to build those relationships. You got to be a line, you got to be a series of interactions, not a dot. Like if you just met someone and ask them for money, chances are that's not going to happen, even though right now market's pretty hot. And so I'm sure it is happening, especially with Series A rounds, but in the beginning, quite a bit harder. All right, so I'm going to speed up a little bit. So you don't go to this second phase until you finish the first phase. And the reason is because if you're having meetings with investors and you can't follow up quickly with your data room, you can't answer all their questions, even if you haven't built up your investor list well enough, like if you're trying to raise £500,000 and you only know investors, that could possibly in total invest £500,000, and you go out to start investing, the investors know that. They know that you're not really prepared and that you're a little bit desperate and you don't really know how it's all going to come together. And I know in the UK, you've got wonderful tax breaks for these early rounds, and that really does help a lot, but you still don't want to make life more difficult for yourself than you need to. So you want to make sure you've got enough investors warmed up before you start your round, and then you can run it really hard. Like this whole process here can just take a month or perhaps even a little bit less. So you send the deck out, you have your meetings, you follow up hard, and then you ask them if they're interested. A lot of founders don't even ask this question, especially if you're not a salesperson, and you all need to learn sales if you're not from sales, in my opinion, but you have to ask them, do you want to invest? Perhaps not always that directly, but it's amazing how often founders won't even necessarily ask that question. But if you don't ask them, they can't say yes. So make sure you ask, and then you're looking to secure either a term sheet or a lead investor, depending on the round and how it's coming together. Pre-seed, quite often there's not a term sheet. It'll just be like someone will say, look, I'm in for 100, and you go around to all the others and close them out. With a seed or Series A, most likely there is a term sheet or multiple term sheets that come in from the investors, and then you sort of look to go and close it out. So getting into closing it out, that's the next phase. So once you've secured a lead or you've secured a term sheet, then you go to closing out your round. So finalizing commitments. So you might get a lead of $1 million or $2 million round. So then you need to go to everybody else and say, right, I've got my lead. This is who it is. This is the terms. Who wants to be in? And once you've got a lead, normally the rest of it falls together really quickly. So you build a book. Sometimes you just scale some people back, or to people they don't fit in. Again, that's quite common as well. It's annoying. Like maybe our last round, I know, like we worked so hard, and then we had so many investors, and we had to tell them that they couldn't get in. It's actually just as much work as getting the investors, which is a bit of a shock. And anyway, it's about a problem we'll all hopefully have to deal with, having too many investors. But yeah, I guess I wish that problem on you. Yeah, so then you do the second part of the DD. So once you've kind of built the book and you've got your term sheet, there is a little bit of legal DD that you need to do. So never tell any lies to your investors ever, especially on legal stuff like the cap table, legal agreements, like your revenue numbers. Just make sure they're so tight, because if they find anything after they've done the term sheet, and then they're going to pull out, the whole thing's going to unravel. All your other investors are going to be pissed off because your lead investors pulled out. Be really careful with your data room. Of course, I think minor sort of accidents and honest mistakes from very early stage founders. Like this also depends a little bit on the stage you're at. Like if you're doing pre-seed, investors are probably going to expect you to not get everything right all the time. But the later you get along and the bigger the round and stuff, the expectations are going to get really high. So make sure you got that there. Sometimes then with closing, you need to prepare and sign a new shareholders agreement with the new terms from the term sheet. Then you've got to actually get the subscription agreement or the con note or the safe or whatever signed by all the investors. They make their payment. Obviously, you can use Cake to streamline this, so please do check Cake out. It does streamline a lot of this sending and signing and integration with the cap table and everything. And then, yeah, the investor payments, you got to issue the certificates, update the cap table, update the regulator. So whether it be ASIC or Companies House or ACRA or what have you, and then you update the balance sheet. So that's the closing phase. So quickly moving on, it is important to understand that these round buckets exist. There are ones in between, as I said, like you can do Seed Plus, you can do Pre-Series A and stuff like that, but you want to try and fit in these buckets, you know, as much as you can to make investors, make it easy for them to make a decision. So, you know, in your pre-seed, there's a range that you know, valuation range that you're raising within, right? And the amount of dilution that you're taking for the round should be around 10%. You don't want to overly dilute. The goal is when you get to Series A, the founders still own, you know, 50, 60% of the company. So you need to only dilute 10 to 20% per round so that you've still got 60% when you get to your Series A. And then the amount that you raise matches to the pre-money valuation. So if you want to dilute 10%, and you're 1.5 million pre-money val, well, that'll be post-money actually, you're raising 150,000 and so on and so forth. So you want to keep the amount nicely balanced with the valuation. And you normally have about 10% allocated to your ESOP or your EMI or, you know, whatever you call the employee options in whatever country you're in. So that's a nice balance on day one. And then as you progress, the valuation goes up. You dilute again for the next round, 10 to 20%, the amount you're raising goes up. Again, keeping the amount that you raise nicely in balance with valuation, which means the dilution percentage is about right. You're probably still using the same employee options when you're doing your seed as the pre-seed. When you get to Series A or even your pre-Series A, valuation goes up again. You're diluting more, another 10 to 20%. The amount you raise goes up, and you might need a new ESOP or EMI at that point because you might have used all the first one. You need to increase the size of the pool or create a new one. For the new founders out there, especially for the non-financial ones, I'll just do this one really quickly. It is a weird concept to get your head around, especially if you're non-financial. So you're going to end up with a smaller slice of a bigger cake is what I'm just trying to like quickly highlight here. So in the beginning, if you're the lead founder with the gray section there, 30%, so you've got, and at the bottom it says it's a $1 million raise for your seed on a $4 million pre, so it's $5 million post. 30% of 5 million is $1.5 million. So you got $1.5 million worth of equity at your seed round. Now you're going to go down over time as the blue section at the top, dark blue, goes from 20 to 47 to 68%, and that can feel bad, right? Like, you know, a big chunk of your company's leaving. There's a whole bunch of psychological stuff that goes along with that, but at the end of the day, that founder has 12% of a $100 million post-money company, so $12 million. So to get from seed to Series C might be, you know, a 5 to 7 year journey, but in this case, they've generated $12 million worth of equity, which is a pretty wonderful outcome. And of course, it can be much higher than that, depending on where valuations go to. At the moment, we're seeing Series C valuations of all sorts of crazy numbers. So, you know, it's a wonderful wealth generation process, you know, even though you are being diluted along the way. So the next big thing I want to talk about is just framing your round from a financial perspective. This is a little snip from the Investor CRM, which is a tool inside the capital raising toolkit. So here you've got minimum and maximum. So minimum 550, target 550, maximum 800, pre-money valuation of 4 million. So then you can see the amount of dilution. So 12% or 16.67%, depending on whether you get the target or the maximum. So really important that you just quickly run those numbers. This is one of the most important slides on this, in my opinion. I really want you guys to understand this, you know, this dynamic. So what I'm trying to show here is that you want to have, right at the beginning of the preparation phase of your round, or even before that, like as early as possible, you want to build an investor list that invests in your niche, in your industry, in your stage, in your country. And you want to start researching them. Look at their LinkedIn, friend them on LinkedIn, send them an email, try and have a coffee with them. They go in that potential capital, aim for 10 times capital needed column. So you write them on the left. So VC, VC, VC. So all the VCs you meet, that you know about, or in all the syndicates and all the angels, you write them on the left-hand side under name, and then you try and find out what their normal check size is. And then you put that in that potential capital column. So what you're trying to do there is just build an investor list that is big enough for you to then go and market to. And you want to have about 10 times whatever you need. So in this case, it was about 500K. So what we want to do is we want to build a list of about £5 million as a starting point. And then you want to be a line, not a dot with those people, right? So you don't want to meet them once and then pitch them the next time. You want to meet them. You want to see if you can engage them in some back and forth dialogue. You don't need that with all of them, of course. You ideally want to have some time in between when you meet them and when you're raising, so you can send them some monthly updates and see if you can get a little bit of interaction with them. Now, towards the middle of your preparation phase, you want to be qualifying them into the next column. So how you do that is you have a meeting with them, you talk to them rough. You might even have a draft deck. You can talk to them about your strategy and your USP and your competition and some of your metrics, and you're learning what the investors think about you and your pitch and everything. It's really important that you do that. As well as that, at the end of every single one of those meetings, you say to them, literally just say, hey, I'm so enjoying our discussion. We're going to be raising pretty soon, as you know. Would you be interested in being part of that? When the deck's ready, I'll send it out and we can have another meeting. And they'll say yes or no, or they might say maybe or whatever. And you're trying to get yeses. If they say yes, then they're qualified. So in this case, you're raising $500,000. You can see here the target up the top. I've got 1.5 million in that column. So I need 3 times my target in this column before I then go into the marketing phase of the round. So if we go back a step, so before I go from this preparation phase to this marketing phase and start sending out the deck, you don't want to send your deck to investors until you're confident your round is going to work, because it just goes on and on and on forever. When you go into the marketing phase and you're confident it's going to work, it will go so much better because you will be confident. The investors will feel the energy. You'll be able to follow up hard after the meetings and say, look, this is happening. Let's do this. Who's in? I've got a lead. I've got 2 term sheets coming in already. Who's in? And then bam, 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 then the energy starts happening. So you have all the meetings with your potential capital people. You ask them who's in. Once you've got 3 times or hopefully even more, then you go, right, I'm running my round, and you send them the deck and you have the meetings and you run the marketing phase. So with finding great investors, do your homework. Don't go cold. They need to invest in your niche. So in your industry, ideally they might have a background in your industry. They need to be active. So you can just ask them, what have you invested in recently? If they can't answer that, and it's particularly important for the very first round, I see pre-seed founders really getting punished for this because it's by far the hardest round. Because unless you're a serial founder or you've done something amazing or you own some incredible IP, and of course, some first rounds are amazing and great. I wish that on all of you, but for most of us, the first round is the hardest because you're doing something innovative. So possibly you sound mildly crazy, and you've got to prove a lot of things before people are going to back you. So that means the finding investors is harder, and then you can get stuck hanging out with bad investors that aren't going to invest. So make sure they've invested in the last couple of months and they're investing actively. Make sure that they, their check size and stuff like that. There's heaps of good lists out here. Specifically for the UK, we've pulled together a bunch of lists there that you'll get afterwards. We also have similar lists for Australia and other countries. If anybody needs them, just ask us for it. So specifically for the UK, unbelievable tax breaks over there. In Australia, we've got like a couple of cool ones. We've got one called ESIC, which is based on this SEIS and EIS program. It's nowhere near as good. These are just so good. I'm so jealous. So make sure you're aware of which one of these you are. The rules are here, and again, we're going to provide this. You can Google it. It's on the HMRC website. So yeah, it's just like really good tax breaks. So your investors, get tons of benefit. So make sure you qualify. So I guess this one's more from me as a founder to you as a founder. Look after your health and your mental health. Getting product market fit is extremely difficult. capital raising on top of that is really, really difficult. I highly recommend one founder allocates, almost full time towards capital raising, and then, the other founder or something, or if you've only got one, you just really need to work a lot of hours during that time frame, because there's just a lot of things to do. Do get into accelerators and incubators if you can. I find that they're wonderful ecosystems for just bringing all that startup superpower around you, like Hyper's doing here. Really connecting to your purpose. It's just so important for getting investors to support you, getting, accelerators to support you, getting your early team members, and even for yourself, just to get that drive day after day, like really connecting to your purpose. Keep building your network and your brand. So every time you meet an investor, don't forget about them, be good to them, be kind to them, follow up with them. They could introduce you to another investor, even if they don't invest. And how you look after your investors or the investor people that will determine whether you get money or not. It's like, as of course, you need to be a good founder and you need to have product market fit and you need to show the ability to drive your company forward. But like how you treat investors and that brand, investors all talk to each other. So it's really important that you act well and you learn and you listen and investors really feel that from you. Learn and keep learning. Again, that's sort of the same thing, and it ties into accelerators and incubators, and get the right resources. Like our capital raising toolkit, I think is wonderful. I think the Cake software itself is wonderful. There's heaps of good tools out there, to help you on your way as well. So just a little bit, the last section here, just, as I sort of said on the other slide, where are you going? What's going to change in the world that you're bringing about? This is one of the most important things. If you can't articulate why what you're doing is super important and it needs to happen, then investors aren't going to want to come on that mission with you. So really get clear on this. If you don't feel like you're clear on it, practice it, ask people for feedback, find out why you're awesome and where you're going and that people really care. And, just to support that, from major VCs in the UK, and it's the same in Australia, they're backing people with ideas that will change the world, right? Don't take this lightly. You have to think of yourself that way and you have to project that amount of energy. If you can do that, investors have a much more likely chance of supporting you and have a little FOMO. Like when I first made this slide, the whole slide was just FOMO, but I thought it was a bit rude to the investors. But it really is important to be the train, right? You've got to be on a mission, going somewhere with power, with purpose, and you've got to have done your preparation for your round, and you've got to be running your marketing section of your round with energy. It's open, it's closing, the term sheet's coming in, like, are you in? If you can't provide that energy, then you're going to have a much more difficult time raising. So I talked about the decks and pitching a bit already. So you want the 10-page deck to get you the meeting. You want the 30 to 40-page deck to present at the meeting. The goal of the first deck is to get the meeting. The goal of the second deck is to get the term sheet. It is essential to have a lead investor on all rounds. If you don't get, pre-seed is arguably not a real round anyway. It is more like an in-between round. If you don't get a lead investor, then it's basically a bridging round. I did learn recently that there's two sorts of bridging round. There's like a real bridging round, which is like, we didn't hit our targets, we need a little bit more money to hit our targets. There's also like an up round, which is not really a bridge round. It doesn't always need a lead. It sort of can be like a pre-series A or a seed 2, where it's at a higher valuation and everything's going well, but it's not a full like A round, and you can sometimes get away without a lead investor on those. And, be prepared. Get your data room ready. You can just use a Google folder. It's really easy. There's been a checklist provided. How much should you raise? So when you're going out to raise, you have to clearly articulate to the investors what milestones you're going to hit. And they need to believe that you can hit those milestones and that when you hit them, you can get more money. Because they're not investing for you for the next 12, 18 months. They're investing in you that over the next 5, 10 years, you're going to do something huge. They need to know that what the things you need to do are to get the next bit of money. You know what I mean? And the later in the rounds you are, the more important that is. Like when you do your Series A, you're basically doing your Series A, B, and C all at the same time to some degree, because the investors want it de-risked. So just think about your milestones, you know, really make sure that they're clear and that you're selling them clearly. Now, how long will it take to run you around? What's happening in the market right now? Like the conditions are really good right now. Will they be really good in 3 or 6 months' time? I don't know, you know. So think about your timing. I would suggest getting into it ASAP. Do be wary of taking excess capital. Sometimes investors will try and put more capital in than you need. It can happen at multiple stages. This can happen at pre-seed. It can happen at Series A. But you know, you really want to be diluting honestly as minimum as possible, because you want to keep as much capital for yourself, but you need to be fair to the investors. So it's normally, you know, between 10 and 20%. I think that the benchmark for the, you know, for the investors, they try and get somewhere between 17 and 23% in every round. If you can get it more like 10%, then it's more in the founder's favor. Yeah, forecast. So it says don't do one, but you know, do a simple forecast, but don't show that hockey stick growth thing in your deck. Like it's not needed. Every single deck kind of has one, and they're all the same. You can just rinse and repeat from one deck to the other. It's much better to talk about what you're going to do with the money than show that you're going to, you know, double. All right, and what do investors want? Like, it's really important that you understand this because you're pitching directly to them, right? So in the first couple of rounds, so pre-seed, seed, they want to get 100% return every year because it's ultra risky. That's when the greatest risk of failure is. Once you get to Series A, Series B, investors are, you know, they're looking for more like a 50 to 70% return per annum. And you can model these things out, but it is important that you can talk about this, right? So if you're raising at 4 million this year, you want to show how you can raise at 8 million in 12, 18 months time, right? And then so on and so forth. And then you need to weave two big narratives together. You need to weave that short-term, you know, double narrative, and then you need to weave the 20x over 5 to 15 year narrative. You need to be able to tell both those stories congruently. So the investors, you know, they're like, all right, what are you gonna do in the next year? Cool, that makes sense. I think if you achieve those things, you can raise again at a higher valuation. Okay, that all makes sense. And then they look at the long term and they go, yeah, you know, look, I think the world will change in this way. And I'm happy to back people in this space, you know, over that longer time frame. So I think this is the last one, or a couple more. So with your cap table and your modeling, these are the two most important things that investors look at in your DD. I shouldn't say most important. So the first thing they're going to do is they're going to look at your top line, you know, numbers. What are your growth numbers? Who's your team and stuff like that. Depending on your stage, it'll depend. Pre-seed is very much about the team. Seed and seed plus and Series A is much more about your growth numbers. But once the investors have done that, they're going to come to this before they invest. So they're going to want to know, you know, has ASIC or company's house been updated? Do you need to do a share split? Have you got approvals from your shareholders to even run the round? You know, all that stuff. If you haven't got that done, that can slow down the round. It can even upset investors so that they're not happy to participate. Cap table modeling as well. You want to make sure that you understand the deal terms, you know, like what terms are they even offering you? This can be a really tricky area. Sometimes I spend quite a bit of time just talking about that. So, you know, is there a drag along and tag along? Who gets to put a board member? So who gets to appoint a director? As a founder, you want to make sure you can always appoint directors. How many directors does the investor get? Do they have veto rights? You know, is there any liquidation preferences? Really important to understand those things. Also, of course, look at your dilution. So, you know, is it pre-money or post-money valuation? How much is that dilution? Have you got the, you know, the employee options in there or not? Really important that that's all in there. If you've got convertible notes or safes, have you converted those properly in the model? Do you understand how they convert with the discount and all that sort of stuff? It can really save you millions of dollars if you get that right versus getting that wrong, especially if you can scale up into being quite a valuable company. So look, in the beginning, get your capital wherever you can. That's when it's the hardest. So, you know, founders themselves, the team, your advisors might kick in a little bit. Certainly use sweat equity where you can. So, you know, use a little bit of your equity to pay for different services, friends and family, bootstrapping, all this stuff. Just do whatever you can to get some traction. You can't raise money from external investors until you have some sort of product and some sort of market validation. You know, the more product you have, the better. And then, you know, just get out there and get raising. There's more VCs than ever. There's more syndicates and angels than ever. you know, VCs are coming earlier and earlier and earlier. It used to be they really only started at Series A. Now they're right down in seed and pre-seed. So it really is the best time ever to raise. So we're going to share this toolkit with you. Hopefully that was really helpful. You know, there's a lot in that. Yeah, so I might now just see how the Q&A is going. Might share, go back and have a little run through that. I don't know if Jessie wants to help me with a few questions, or
Jace,
how we run a little bit of a Q&A to finish.
Yeah. So there's a couple here in the Q&A. Cal's been answering a few in the chat. So
cool.
We've got here. What other things? I think we covered this, but maybe you can recap. What are the things which we need to keep in mind while choosing an investor? So that was kind of covered a little bit in your slides, but yeah, maybe if you want to touch on that a bit more.
Yeah, like it's a really good question. Actually, I love it when founders are thinking like that. And it's a really complicated answer as well. Choosing investors is, you know, like, I must admit, more often than not, they choose you. I think in some ways it's like, what do you not want to have, right? So what are you not willing to accept? So one thing I would normally recommend doing is getting a standard term sheet that's very common in your country, and then just go through the terms and you sort of try and work out what sort of terms you're going to accept. And then if an investor comes in with onerous terms or you know, difficult stuff, like someone said there, investors are looking for 100% return. So I can kill two birds with one stone here. Some of them do want their money back, you know, right up early on, and that's a really bad sign. You know, you don't really, that's not what investors are supposed to be doing. They're supposed to be with you for the long term. That would be a red flag. What I meant there was they're just looking for their, you know, their investment to increase over time. If they're a good investor and they like you, they want to see it going up, and they'll keep investing because, you know, they want to keep backing their winners. So look, if they're in your niche, they believe in your vision, they're going to back you early. They don't have to want to follow on, because not all investors can do that. The normal portfolio theory for an investor is they're going to have 20 or so investments, can't follow on in them all. They're going to choose a handful to follow on. So, you know, but you do want them to have that intention. You know, sometimes you might want them to come on as like a director or an advisor as well. And that can be a double-edged sword, because sometimes they'll give you extra shit advice and you can't get rid of them. Excuse my French. But, you know, like that can be good. Sometimes you take a strategic investment, but again, they're a double-edged sword, because sometimes they can be a real pain in the butt as well, and you get stuck and you can't get rid of them, and they're in your industry. So you've got to be a little bit careful with that, but that can quite often be a good thing too. But yeah, so I guess you want a bit of a balance. You do want people that, you know, want to support you. They don't have to all want to be part of the journey though. Like, silent capital is good capital. You know, you can't have all your investors ringing you up every week wanting a chat, because you're going to lose your mind.
Too many cooks or too many chefs or whatever they say.
Yeah.
All right, cool. Thanks, that one. We've got another one. How does everyone go about pulling up data of competitors? For example, how much market share they have and what they are losing out on. A really good one is Crunchbase. I don't know if everyone's heard of Crunchbase. We find out a lot of information about how much competitors have raised and what valuation, stuff like that. But you might know some more, Jace. What do you reckon?
Yeah, Crunchbase is good. Competitor data is really difficult in the startup space, because quite often you're in like a new little niche, and like there's not a lot of reporting, and then to pay for like CB insights is like 10 grand. So it's actually one of the hardest things to do. So you just need to probably lean on your advisors, lean on accelerator networks and stuff like that, and just kind of like piece it together as best you can. But it's a tough one for sure. Yeah, I've always found it really hard.
Yeah, it's a little bit opaque, isn't it? Okay, another one. Process of building a board of directors. What should their compensation be?
So depending on the stage, so just say like right at the beginning, pre-seed and seed, a really good way to do it is using the Founder Institute FAST. So if you just type in Founder Institute FAST, it's US based, but it's very relevant across the world. We use it a lot. We recommend it a lot. At the bottom of that table, it'll basically explain to you, based on the stage of your company and how much strategic impact the advisor is having, how much equity they should get, and it's sort of like, you know, between 0.1 and 0.5%, you know, and then, but it vests over time. So if they're not delivering, you can sort of stop at any time. So that's a really, really good way to do it. Most board members don't want to be paid cash because they're normally fairly successful, and they should be putting money in rather than taking it out.
Yeah.
I think board members that want to get paid, I don't know, like certainly in some circumstances that's going to work, but would normally raise some questions for me.
Yeah, okay. Good answer. Okay. As a solo entrepreneur without staff on a payroll, am I at a disadvantage when trying to raise?
Yes, I think so. So you can sort of get away with like a little bit of pre-seed friends and family money in that stage. That's considered really as part of the bootstrapping phase. I personally have never seen an external round done while a startup is a side hustle. So I think the story there has to be, I'm raising this round so that I can go full time in the business.
Yeah.
And you need to work out what the minimum amount of money you need to earn is, you know, for say like a 12-month period, so you can really, really commit. And then in that 12-month period, you need to hit the milestones to do the next round so you can keep making it your life's mission and your full-time job.
Yeah. And Dan, we've got, how do you assess the valuation? I think you guys have a couple of spreadsheets and stuff like that to help with things like that, as do we. But yeah, there's a few different ways, isn't there?
Yeah, there is. I like to use one of 4 methods. So for the very first round, we use the Burkas Method. It's like a globally accepted method. I don't know, you guys might use it as well. So yeah. There's just 5 questions that you ask yourself about the company, and you give your score between 1 and 10, and then you multiply it out, and it gives you a valuation up to a maximum of 2.5 million. You know, we need to be aware that it's a really buoyant market for valuations at the moment. So you might need to add a little bit on that right now, which is nice for everyone, but it's still a really solid method. There's also some very, very basic rule of thumb, you know, for what stage you're at, like am I idea stage, am I MVP stage, am I MVP plus revenue stage. I think most investors in that early stage will probably just look at you and look at your deck and go, right, 4 million or 6 million. There's not a lot of signs to it. And that's why I always say don't muck around too much with it. Once you get to, you know, pre-series A and series A, then you can start to do, you know, the best method there, in my opinion, is you see where your ARR is going to be in 18 months and you work out what your valuation will be at that point. So 20 times your ARR or something like that. And then you just chop it in half and you say that's your valuation. And then you just sort of test that with investors. And again, that's a pretty solid method.
So for most of the people on this webinar who are joining it for the first time, you'd suggest the Burkas Method, and we do have a spreadsheet for that as well. Anyone needs it, but it is quite straightforward.
But if you're in revenue, you just do it more, a little bit by stage. So yeah.
Yeah, cool. What is the difference between a crowd fund on, say, Crowdcube and a VC? How does this affect the percentage giveaway?
It doesn't affect much. Normally still in that 10 to 20%, whether it's crowdfunding or a VC. So the amount you get diluted is the same. The type of investor gets a bit different. So with a VC, you get a professional investor, and that, you know, there's a whole bunch of stuff that goes along with that. Like they have very high expectations for you to deliver, and you know, the bad ones aren't going to look after you if it doesn't work out.
Yeah.
You know, with a crowd fund, you know, you have a lot of retail investors. So, you know, I guess there's perhaps a little bit less pressure than a VC, but then you have the other issue of dealing, you know, having lots of investors to look after. So, you know, they've both got their pros and cons, but both very good ways of funding an early stage company.
And then the next one, what should be included in the short pitch deck and what in the long pitch deck?
Yeah, all right. If you give me a tick, I'll just pull it up on my screen and have it all in my head. Hopefully I can find it in a reasonable amount of time. Here we go. Pitching. I'll just share my screen again. So in the capital raising toolkit, you'll get access to this Notion, and this is the page on pitching. So in here what? So it's 10 slides. The most important slides are the mission. So again, back to that purpose, what's the huge impact? And then the team, why are you so awesome? So you guys are all very early. It's so much about you. And it can be anything. It can be you have very good insight into the industry. It could be your passion. It could be, there's a range of things that you could tie into, but you really need to, understand what that is and be able to pitch that hard. Some sort of traction, even if it's not like real traction, just customer research and customer validation and whatever you've done. And then talk about, how quickly you think you can get to 1 million in ARR or whatever revenue metric. There is also a pitch deck template in here. It's it's got all the main slides. So the problem we're solving, the solution, the opportunity, the target market. Like this has got no design, but it tells you, the pages, the competition, and the team. So that's all in here. The long pitch deck. It basically just goes into everything in much more detail. You can even end up with 10 pages of appendix as well. You guys are all very early, so it's not going to be huge. But then as you get to sort of your seed and Series A rounds, the long pitch deck gets bigger and bigger. But probably the way you could think about it is do the short pitch deck and go out and pitch it. And whenever you get asked a question, write it down. And then if you get asked a question more than once, make a page for your big pitch deck. Basically, that's it. And then if it's not that important, put it in the appendix. And if it is important, put it in the main part and present it when you actually go and raise money.
Yeah, good one. Yeah, that toolkit looks awesome. Everyone's going to get sent a link to that. So, okay, Wesley, do you have any tips with negotiating with leverage equity and tips to avoid a bad deal?
So I think you're saying how do you just make sure you get a good enough deal? So doing your homework, I think, is the big one. So just know what deals are happening out there. So if someone offers you a bad deal, you kind of know. So ask other founders, get into accelerator groups and just find out, generally what range you think your valuation should be. Also set the maximum amount of dilution that you want to take and really try and avoid being over diluted, because that's another way you can have investors crush your cap table and really mess with your product. Avoid things like multiple liquidation preferences. That's probably the number one risk. So if it's more than a 1 times non-participating liquidation preference, if you don't know what that is, talk to us and we can help you. But it just means that when you sell your company, if it's 2 times or 3 times or 4 times, the investors can get 2, 3, 4 times their money back and still keep their shares in your company when you sell it, right? Yeah. So avoiding things like that, making sure you can keep your own board seat in your own company, stuff like that. So just doing your homework, and unfortunately you will make mistakes. I guarantee it. I made a bunch of mistakes and I'm like a CFO, so it's pretty hard. Just do as much homework as you can.
Yeah. And make sure you read the term sheets and know your term sheet back to front as well, so you're not don't get stuck. Okay, and
read term sheets before you raise, because when you first get one, if the first time you read a term sheet is one that you need to sign, you're in trouble because it's so complicated. Try and read them beforehand. Definitely.
And then we've got a long question, but it's essentially asking sort of how to demonstrate traction. So best ways to demonstrate traction.
So if you guys are really at that ideation and MVP stage, you just need to get your product in your customers' hands as much as possible. So if you don't have a full MVP, if you haven't actually sold them anything, if you don't have revenue, it's going to probably be customer interviews, as clean a customer interview as you can, with clear questionnaires and then outcomes from that. Partners as well. So sometimes you can do partner interviews, get partner validation, because then that obviously helps you with your customer. And then just get a website up and see how many clicks you can get. Maybe try and get a wait list, try and get some conversions on some of your ads and stuff like that, because that proves the concept too. Probably 3 good things you can do if you haven't progressed too far with your product and your marketing.
Great. And then last one, what is your opinion about founders that will potentially not move full-time but were present during the initial phase? towards that MVP. So, so I presume they're talking about if there's a number of founders, not all of them are full-time.
Yeah, like it does happen for sure. You really do want founders to be really committed. What you don't want though is those founders holding too much equity going forward.
Yeah.
So if you had it as like a 33% split with 3 founders and one of them leaves, they really should go down to like a very small percentage, especially if you're still at the MVP stage, because nothing's really happened yet. So
yeah,
I don't know, like you kind of want them off the cap table, really.
Yeah, anyone, that's not working full-time in the business, you don't want them to have like a majority or any sort of large.
You want to try and get them down to like a nominal couple of percent or something, and say, hey, look, like if we do well, we want you to win, but you know, like this, we've got a long slog ahead and whatever.
Definitely. Cool. That's all the questions. Thank you so much, Jace. That was awesome.
All good.
And we'll everyone will get the recording sent out, and I'm sure we'll be doing events together again in the future. So thank you so much for your time. Really appreciate it.
Yeah, really glad to share, and reach out if you need any help, and good luck with your journey, and thanks for having me. Cool.
Okay. Thanks, Jace. See you, everyone. Have a good day. Cheers. Bye.